Are you ready to uncover the next big investment opportunity? Emerging markets are ripe for exploration. After years of underperformance, they've begun to show potential. Today, we'll dissect why reallocating to these markets might be your next best move. Emerging markets have just outperformed developed markets for the first time since 2017. The MSCI Emerging Markets Index surged by 34% in 2025. This performance was fueled by a weakening dollar, falling inflation, and the desire to diversify portfolios. However, geopolitical events have caused a pullback. The February 2026 strikes on Iran led to skyrocketing oil prices. Emerging market currencies faltered, and investors wondered if the growth story had ended. But leading portfolio managers believe there's still a compelling case for emerging markets. The investment thesis goes beyond recent events. It originates from several long-term structural factors. First, let's examine valuations. Emerging markets are trading at about a 40% discount to developed markets on a forward price-to-earnings basis. This stark contrast reflects a significant shift in investor focus away from U.S. assets during a decade of dollar strength. Next, consider the debt situation. Developed economies are burdened with debt exceeding 100% of GDP, while many emerging markets have managed to lower the debt ratios. They come out of the pandemic with stronger balance sheets. Inflation trends serve our case, too. In many developing nations, inflation now sits at historical norms following aggressive central bank rate hikes. These conditions are setting the stage for economic acceleration. Now, let's talk about the dollar. The structural drivers of dollar strength are gradually shifting. The recent boost from geopolitical events could fade, positioning emerging markets for a rebound as dollar weakness returns. The recent Iran conflict has created a clear division among emerging markets. Two categories have emerged: energy importers and exporters. Energy importers, like South Korea and India, experience rising costs and inflation pressures due to increased oil prices. These nations can struggle with energy price jumps, complicating their economic growth. On the flip side, energy exporters, including Brazil and several African nations, thrive amid high commodity prices. They benefit from better current account balances and greater fiscal flexibility. For example, Brazil's strong commodity exports position it advantageously. Higher global prices directly support its economy. Colombia also stands to gain as an oil exporter, despite facing some political uncertainty. The undervaluation and potential of Latin America provide an attractive reallocation opportunity. It comprises only 0.1% of the MSCI All-Country World Index, making it vastly overlooked. Brazil's stock market saw a 74% rally from its 2024 lows, yet it trades below long-term averages. As Brazil enters a rate-cutting cycle, its economic activity is expected to improve. Colombia presents another opportunity. Despite investor concerns around political uncertainty, it remains an oil exporter. The current market discount is seen by some experts as a worthwhile entry point. In the EMEA region, Turkey offers high-stakes potential. Previous political missteps have skewed market perception, but recent shifts in monetary policy suggest a recovery. Investors looking for underpriced opportunities might find them in dollar-denominated Turkish debt. Central and Eastern Europe also presents options, with yields still attractive despite improved fundamentals. Moving to frontier markets, countries like Pakistan, Kenya, and Egypt have been labeled sleeper stories. They may have yet to attract mainstream attention, but sharp inflation declines position them well for growth. As central banks cut rates in these countries, the potential acceleration in economic activity could catch many off guard. However, we must acknowledge risks. Emerging markets face three key threats requiring vigilance. The first is the dollar's fate. If geopolitical uncertainty drives demand for the dollar, emerging markets could suffer setbacks. The second risk is a potential global recession. Sustained high energy prices could threaten global growth, affecting all emerging markets. Finally, the duration of the Iran conflict remains uncertain. If it extends into the summer, economic models for many nations face challenges. In summary, we have compelling reasoning to consider emerging markets closely now. Factors like cheap valuations, falling inflation, and a weakening dollar create a strong structural case. Emerging markets represent approximately 60% of the global population yet comprise only 11% of the MSCI All-Country World Index. The gap between economic presence and financial representation is historically extreme. The question is no longer if investors should look at these markets, but when and how they will allocate. For those underweight in international exposure, now is the time to act. If you're ready for your portfolio to embrace the emerging markets opportunity, don't wait for resolution, seize the moment. Emerging markets are changing, and now is your chance to get ahead of the curve.